Hey everyone, welcome back to Yuri's Box. In this video, I'll be talking about TLT, the long bond thesis revisited. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So before I start, I just wanted to say thank you to everybody that has been interacting with the videos, liking, subscribing. Again, the summer is usually my busiest time of the year, so I won't be making as many videos. You already probably noticed that. But regardless, subscribers keep going up, and we're close to 200 subscribers, and all I can say is thank you. And again, the biggest thing I had to get used to was really talking while knowing I'm being recorded, but hopefully I gotten better, and hopefully I'll just continue to get better and make these videos as enjoyable as possible. So let's get down to business here. I think that the title, the brief summary of this video could be: tariffs didn't break it, trade deals won't fix it. And I'll get to that later. And I think it's worthwhile to do a recap of everything that I've been saying in these videos so far, ever since I started making videos, which was in February. That was February 12th, and that was the hot CPI we got for the month of January, if I'm not mistaken. And basically, what I was saying in that video was that probably the growth outlook was a little bit too optimistic, and people's expectations of inflation was a little bit too pessimistic. I'd probably have to flip the script, is what I was saying. And while we're at it, I think that it's worthwhile also giving you, insight on this schmuck's interpretation of this economic cycle, which has definitely been very, very hard to interpret. I don't pretend to, I don't assume really that this is the correct way to the correct interpretation, but again, it is the way I'm going about things. And that is the following. As Jim Bianco puts it, each crisis brings along some changes. Now, change doesn't mean worse, it just means different. And I generally agree with that. Where I probably disagree with some of this part of the take is that this cycle is somewhat unique, and that we are living through unprecedented times, and we're navigating uncharted waters. And that is where I generally disagree, because it goes back to something as simple as the quits rate. And what I've been speculating is that the pandemic has basically helped us break out of the 2010s malaise. A period of time where the quits rate was really just grinding higher slowly, and it took 10 years to get back to 2005 levels. And the reason why this is significant is because the quits rate, in my opinion, is really kind of a survey of people's feelings, not via their opinions, but via their actions. If people are quitting their job voluntarily, that means that they feel confident, firstly, that there are other job openings, so that when the quits rate is high, people see abundance in the economy, and that gives them leverage. But second, and most importantly, is that they actually have the confidence to act in a risk-taking manner, right? And that is something that you don't really see during the 2010s. It took us, again, 10 years to get back to 2005 levels. So what makes the 2010s different to everything that we saw before, and basically the 2000, the boom and bust cycles, is that we didn't really have a boom, and therefore you couldn't have a bust, because there wasn't really much risk-taking behavior during the 2010s. Another way you could visualize that potentially is the stock market, right? Even in the face of the stock market going up, people's intentions didn't really change. Growth was low. Inflation was a problem to the downside. Excuse me. If you recall, all the central banks were trying to stimulate inflation. They were trying to get inflation up. They're trying to get it up, but no can do. And again, even with the stock market going up, that didn't change things. People didn't spend the money that they generated through the stock market. All they did was sit on it. They perhaps, yes, felt better that, their net worth was going up, but they didn't spend it. Why? Well, what if another 2008 happens? I don't want to get caught with my pants down again, like I did in 2008. I want to be ready this time. And so that really put everyone in a psychological mindset, rather, that we were all collectively trying to get over the 2008 trauma. And so you can call this a silent depression, you can call it a malaise. I probably, prefer the malaise definition of the 2010s. Low growth, low inflation, people really not acting in a risk-taking manner. And again, that just kind of reinforced this sluggish environment. All right. Excuse me again. But then what happens? You get the pandemic. And what happens during the pandemic? Well, you basically lock everyone in their homes, basically lock everyone in a cage. And all of a sudden, it's not a question of, do I feel like going to a restaurant? Do I feel like traveling? Is that it becomes a question of, even if I wanted to, I can't, because I'm forced out of it. I have to stay at home. And when we have the reopening, people have this pent up, need, all this demand to go out and do everything. Because again, what happens if we get another bout on COVID and we're locked in back in our houses again? Well, we're not going to go to restaurants anymore. We're not going to travel again. So we might as well do it now, just in case. Who knows what might happen. We might not have another chance to do it. Now, again, this was also fueled, especially by the fiscal side of things. We had the stimmy checks and, all that good stuff. Absolutely. But what is significant of this cycle right here, in my opinion, is that the post-pandemic recovery really catapulted us back to something that is more akin to the pre-2008 world, a world where you have boom and bust cycles. So really, we broke out of the 2010s malaise, effectively. All right? And that is how I'm interpreting this cycle here. Now, definitely, this cycle has things that are unique to it. No two cycles are never equal. They're never the same. There is always something that sets one cycle apart from the other. But the DNA, if you will, of this cycle is more similar to the pre-2008 world, where you have booms and busts. Again, where you have people overdoing it on the upside and having to give some of it back. In the case of the 2000 recession, and in the case of the 2008 recession, gave a lot of it back. All right. So that is the basic framework. All right, that is the groundwork. That is the foundation of this call. It's that eventually this cycle will play out, kind of like the pre-2008 world, where people overdo it on the upside. They try to keep that standard of consumption as high as possible for as long as possible, but eventually they have to face the music, and you have to give some of it back. And depending on the severity of the downturn, you give more or less back. That is basically the general idea. All right. Now, what can we look to reinforce this outlook? Well, one way you could define the current state of the US economy is that it is a low fire, as represented by the initial jobless claims, low fire, but also low hire environment. So you have People aren't hiring as much as they were back here. In fact, if you look, we're back at 2015 levels, well below pre-pandemic, what we saw during immediately preceding the pandemic. But we also have low firings, all right? Initial jobless claims are still stubbornly low, which is a good thing, of course. And this is often pointed at, by pundits as a reason that, everything is fine. As long as the layoffs aren't going up, recession fears shouldn't be elevated. Because again, we all associate recessions with the loss of jobs. But this is where I kind of, take a step back and you kind of look back at history and you realize, and or at least I realize, that it is important to make a few key distinctions here. If you're waiting for initial jobless claims, or rather the fire part of the equation, to really break out in a significant manner, you're waiting basically for the recession to be already over. And what do I mean by that? If you're waiting for the fire or the initial jobless claims, let's use that as a proxy, to peak in order to say we're in a recession, you're already in the recovery, is what I'm saying. By the time initial jobless claims peak, that is usually the end of the recession rather than the beginning. And so you really have to flip the script here once again. The fact that we are in a low hire and low fire environment isn't necessarily anything to be too comfortable about, because yes, recessions are an environment where people lose a job, absolutely. But it is really the end of the recession where we see the loss of jobs. The beginning of an economic slowdown starts with low hires, the hiring rate coming down, or in the case of 2007, actually stalling. Okay, so that is what I think we should all focus on. Hires being well below the peak that we saw in 2022 and well below the pre-pandemic levels. Yes, we all associate recessions with the job losses, but I would argue that the early innings of a recession is the lack of hirings. And as you progress through the slowdown, if things get bad enough, yes, you get the job losses. But it is only at the end. And again, the way I've jokingly spoken about this is that if you're a policymaker, if you're waiting for initial jobless claims to cut rates, for example, that is basically like saying, I'm going to wait until I smell like rotten eggs before having a shower. You're already late at that point if you're waiting that much to have a shower. So again, this is something else we can also point towards. And again, surprise, surprise, we did see something similar occur in 06, and 08. We had the hirings kind of stall out here. No longer in a boom, and eventually go down. But at the same time, initial jobless claims were still relatively low. All right. The only time, by the time they broke out, it was June of 08, basically. And at that point, we were really closer to the, near the end of the recession and the actual beginning. So I think that is important to highlight. Just because we are in a low hire and low fire in jobs market isn't really anything to be too proud of. Because again, this is exactly what you saw in the pre-2008 world. Hirings really stay sluggish. which in turn acts as, a tailwind to potentially the unemployment rate. People unemployed for 6 months and over have been going up. And another way you can look at it as is the where do I have it? Initial jobless, continuing jobless claims. You have continuing jobless claims well above the low. Now again, this is very low, okay? But, you could make the argument that they are in a consolidation and potentially looking for a breakout rather. So low higher is another thing that we could point towards, to reinforce this idea that, this cycle is potentially playing out just like we saw, in the pre-2008 world. We have booms and you have busts, people overdoing it on the upside, people having to give some of it back eventually later on. Another way you can look at it as, again, going back to the quits rate in relation to the job openings. Again, what does the quits rate tell you? It's a survey of of how people are feeling, and it's not done via asking people their opinion. You're doing it looking at people's actions, that is, okay? If people are quitting their job, it means they feel confident, they see abundance in the economy, they have a lot of other possibilities to switch jobs, and in turn, that pushes up wages. And this is something else I'll be returning to later on in the video. But if the quits rate is at cycle lows, the opposite is true. They no longer have, employees no longer have the leverage, employers have the leverage. And the way you can visualize this is simply by looking at job openings, the level of job openings. Yes, we are not at 2007 levels, but we are well off the highs, and we are, again, at pre-pandemic levels. And again, one way you could visualize this as well is just look at when job openings peaked, 2022, February and March of 2022. Quits peak in February and March of 2022. This is telling us that people don't really feel that great about the economy because they see the fact that they don't really have all of the opportunities that they had in 2022. Things have changed. We are no longer in an environment where, a lot of job openings, people could switch jobs easily and in turn, have leverage in the labor market. People no longer have the leverage in the labor market. Employers have leverage in the labor market. All right. And that I think that is a key distinction to make. So kind of to wrap everything up, this first part of the video up. This cycle, in my opinion, is more akin to the pre-2008 world. And that because the reason what caused that is the post-pandemic recovery, all that pent-up demand fueled by stimmy checks, the fact that people didn't have the opportunity to go out and spend during that year and a half, actually changed the way we feel about life in general, if you will. We're no longer worried about another 2008. We just want to go out and spend. And that's what people did, And so that puts us in a situation that is more similar to the pre-2008 world. We are no longer in the 2010s malaise, that is, okay? Now, we have the quits rate, again, telling us that we're no longer at cycle highs, meaning that people no longer see abundance in the economy. And the way you can look at that is through the job openings level. We are in a low hire and low fire environment. And while, yes, the fact that firings have absolutely been low, that is great news. But you kind of have to rethink the way you think about recessions, in my opinion. Yes, eventually, if recessions get bad enough, you see a lot of job losses. But the early innings of a recession are a lack of hirings, right? Companies aren't hiring as they were before. That is really what lays the groundwork for a recession to occur, in my opinion. And in turn, that puts upward pressure to continuing jobless claims, and again, the number of people that are unemployed for 6 months and over. And again, we're still at the lows, but the trend is definitely up. Now that leads me to today, and I'm very close to talking about TLT. And the two things that you really have to address here is the Fed, and so the way they're talking about inflation and growth. And the second thing is the fiscal side of things. So let's talk about the Fed. A lot of a lot of people are really surprised, if you will, at the fact that the Fed is really taking a how can you put it, a watch and see approach. Okay, they're basically saying one way or the other we're going to be late. We're just going to wait and see what happens, and we'll react to that. And people are saying that this is kind of a bug of this Federal Reserve in particular, because they're looking backwards while they should be looking forwards. But I've always argued that the Federal Reserve has never been in the business of being proactive. The Federal Reserve only does one thing, and it reacts. It reacts to whatever it is smacking it in the face in the short term. And the best way you can visualize this is I'll go back to that article in just 1 minute, is the June of 2024 Summary of Economic Projections, and the SCP immediately after that one, so September of 2024. And just look at the dot plot. Just keep things simple. 2024, June of 2024, everybody was chilling around, 5 and 5.5, right? That's where participants saw, the target rate for 2024. All right. And why were people, members of the FOMC stuck in this range right here? Well, if you recall, inflation from really December, or rather, November of 2023, was really misbehaving, if you will. And again, November was when, Powell said, if inflation is well behaved, we'll be able to cut rates a lot, or we'll see rate cuts. But sure enough, inflation wasn't well behaved. It peaked out in March of 2024 at 3.5. Yes, it went, by the time, we had June's ACP, it was down at 3.3%. But, again, it wasn't showing any really good progress. It had bottomed out in June of 2023, and a year later, we were higher than where we were in 2023. So that was really a representation of the fact that the Fed was reacting to high inflation, higher than they would have liked it to be. So everybody's saying, yeah, you remember all those rate cuts we said in November? Forget about it, man. Absolutely no. No way. Okay. So the summer comes around. We have the growth scare, and we have further disinflation, more than anybody was expecting. And we bottom out at 2.4%. All right, so keep in mind, at this point, we had a growth scare, and inflation was on the downtrend, potentially going lower than people would have liked it to go. Sure enough, in September, what do we have? FOMC participants take the elevator down, and they start pointing towards rate cuts. If growth is slowing down, man, we have to cut rates by a lot. We have to start, easing, because the economy won't hold on. And this is really a synopsis, a very brief summary of what the Fed does. The Fed never acts in a proactive manner. It never looks into the future. It never looks at the future for answers. It looks at the past for answers. So anything you hear from the Fed, we're not going to cut rates anymore. We're going to cut rates. Whatever it is they say, it is a function of what has already happened. And by the time they do something, it's because that something is a reaction of, something actually happening, meaning that they're late. That is basically it. That is all the Fed ever does. It is late. Because it doesn't look to the future, it looks to the past for answers. It takes a data-dependent approach. And, for context, this is where I bring the article back. This isn't only a bug that is associated with the Fed. A lot of pundits out there run into this mistake quite a lot. And again, I've spoken about this many times in my previous videos. One of the reasons why, I point towards 2006, 2008 is because I do see some similarities between the narratives behind inflation. In 2008, we actually had inflation. And lo and behold, in 2008, in June of 08, which, just to put it on a map, inflation was at 5%. And this article was, again, from June of 2008. The Federal Reserve is starting to talk tough about inflation. Yesterday, Federal Reserve Bank of New York President Geithner, following a speech in New York, that tighter monetary policy from central banks around the globe may be needed. Bernanke said, Bernanke hinted that the Fed's rate-cutting campaign has come to a close. The latest round of increases in energy prices has added to the upside risk to inflation and inflation expectations. He added, the Fed will strongly resist an erosion of longer-term inflation expectations. And again, I'll probably leave this link in the bio below so you can read it. It isn't a long article, but what it is quite telling that in June of 08, while we had the worst recession brewing, since probably the Great Depression, people were worried about inflation. Okay. And again, you also had Fed speak. Who was this? The Federal Reserve of New York president, Geithner at the time, Bernanke even was looking at inflation. They were looking at inflation because it was being misbehaved. All right. So again, don't expect the Fed to tell you what will come next. The only thing the Fed will tell you is what has already happened. Their words and their actions are only a function of what has already happened. All right. And again, this leads me to further touch on inflation just for a bit before I move on. While we're at it, the reason why I talk about 2006 and 2008 a lot is because back then they had inflation. Today we have inflation PTSD, as I call it. We have the fear that this is going to happen again. And, not to be, I'll move on briefly now, but the reason why I generally fade that is because the conditions that allowed inflation to run wild in 2022 have largely dissipated, in my opinion. Quits rate is no longer at cycle highs. Job openings are no longer at cycle highs. And hirings are no longer at cycle highs. And initial jobless, continuing claims are primed for a breakout, in my opinion. Okay. And mainly, I would point, if I had to choose one thing to look at, I would look at the quits rate. What does the quits rate mean again? People quitting their job voluntarily because they see other possibilities, and the fact that they have other possibilities in turn means that they have the possibility of going to their current employer and asking for a raise. If the quits rate is at cycle lows, that really that possibility dissipates. You really don't have a way of pushing your wage up in a significant manner. And a way of visualizing that is just looking at the wage growth tracker. Now, again, are we, at, what was this? The lows of, 2021 at 3%. Absolutely, no. But we are again at 2007 levels. Most importantly, we are at 4.3, which is well below the 6.7% peak that we saw in 2022. And again, this is a consequence of the fact that, the labor market is cooler, much cooler than it was in 2022, putting inflation risks really in the passenger seat, in my opinion. And this is also relevant when it comes to the fiscal side, right? Low quits rate, sluggish wage growth, low risk to inflation. But again, moving on to the fiscal side, we actually did have something that could spur inflation. We had tariffs. We had the tariff drama. And eventually that will have an impact on prices, all right? In my opinion, that will occur when we actually work through the inventory that we built up during this time frame right here. Right, in the lead up to April 2nd, the companies front run the tariffs. And so they built up a lot of inventory. And whenever that inventory starts to, we start working through that inventory, we'll have to replenish that inventory at higher prices. And eventually you could see a bump in inflation. Absolutely. But what I've been arguing so far is that any bout in inflation is more likely to cause further disinflation down the road than more inflation. If you will, it's a form of disinflationary inflation, as ridiculous as that sounds. And the reason for that is because, again, of everything that I've said before. We no longer have a red-hot economy. We are no longer in the boom phase of the economy. We are transitioning from, in my opinion, the boom to the bust, but we're still not at the bust. But again, we're not in the conditions where we don't have the conditions that allowed wages to push up in a significant manner. And again, any bout in inflation is more likely to compress the ability of people that people have to spend. What do I mean by that? The example I've given many, many times is, imagine you have to go out and buy a car, all right? Universe A, no tariffs. Universe B, tariffs. Universe A, no tariffs. You have $10,000 left at the end of the month to spend on whatever you wanted to spend it on. In a universe with no tariffs, you have $5,000 to put down on a down payment for a car. That leaves you with $5,000 to spend on everything else. All right? Universe B, you have tariffs. And instead of having to put down $5,000, let's say you have to put down $7,500. That leaves you at $2,500 to spend on everything else. In essence, you're spending more money on the same amount of goods, leaving you with less disposable income to spend on everything else. So I said, whatever you want to spend it on, booze, liquor, strip malls, whatever. Enjoy yourself, man. But you have less money to spend it on. Okay. And that is the key difference with 2022. If we had tariffs come in 2022, could they have added fuel to the fire? Absolutely. Absolutely. But I think that given everything I've said, I would take the under. Any bout on inflation will likely compress people's ability to spend. And because people have less ability to spend, I also believe that it is also a pipe dream, a bit of a pipe dream that, let me see if I still have the data here for CPI. Oh yeah, here we are, PPI. This idea that, companies are just going to have a swell time passing costs onto consumers, I think it's kind of misplaced, given everything that we've said about the state of the consumer, which is quite weaker than it was in 2022. And what this will result in is a compression of margins. All right. If revenues stay more or less the same, but your prices go up, that profit margin starts to shrink. And the only way you can protect that margin is, if you can't raise prices, that is eventually you'll have to proceed to layoffs. Eventually. But why did I bring up the PPI? Because again, if you look at some of the components here, you do have some goods inflation, all right. But what you also have is services declining, and I think this is quite telling in my opinion, because while you do have some goods inflation, it is coming at the cost of other sectors of the economy. Meaning, again, what I just said, people are having to spend more on parts, one part of the goods, but they end up compensating for that, by spending less somewhere else. Another way of looking at this, if I still have it open, is CPI. Airfares are in deflation. All right, and while you might see, some other components go up, where was that? Energy goes up. All items less food and energy. You do see some inflation here and there, but it is coming at the expense, so far at least, of other parts of the economy. Plain and simple. Why? Well, because you don't really have a way of pushing incomes up. And if people's ability to spend stays the same and they have increased costs, again, they'll spend less somewhere else. And the same is true for companies. If companies see that the state of the consumer isn't what it was in 2022, where they could just, increase the price of a Pepsi, by $50, they won't be able, basically, to increase that, to pass on prices to the consumer. So revenues stay flat, input prices go up, margins get squeezed, and eventually you have to lay off people. So that is also where I'm putting tariffs. I'm putting tariffs in the bucket of disinflationary inflation, that is, okay? So we might see about an inflation, probably. I'm not ruling that out. But what it'll do, it'll just exacerbate everything we talked about. It'll just add fuel to the downside, in my opinion. Because again, people don't really have the tools that they had back in 2022 to keep up, or at the very least keep up with inflation. Okay, so that is how I'm going about with tariffs. And again, going back to what I said at the beginning of the video, tariffs didn't break it, and so trade deals won't fix it. These factors predate Liberation Day. These were things that were well in motion, well before Liberation Day. This is a process that has been in motion for quite some time. And it won't be trade deals that stop it. And also, I'll bring something else to the table as well. If tariff fears push demand up in the short term, because you don't want to be the schmuck that buys, tariffed goods, you want to spend as less as possible, less money as possible. What does the possibility of tariffs coming down do to demand? Again, if the possibility of tariffs pushes demand up, if the possibility of tariffs coming down, what would that do to demand? It would push demand lower. It would actually add fuel to the fire until you don't get, some kind of a resolution on the trade front. Because why would you invest? Why would you make huge decisions if you're a company? Why would you buy goods if you're a consumer? if you knew that there's the possibility of purchasing said goods at a lower tariff rate. You're just going to wait. All right, so that is something else to consider as well. Tariffs, the possibility of tariffs pushes demand up in the short term. The possibility of tariffs coming down pushes demand down in the short term. So I would also keep that in mind. And again, we currently don't have trade tariffs. Trade deals. And while yes, we've had some reprieve. I will just remind everyone that we don't have trade deals. We don't have anything substantial yet. We have 10% on everyone and 30% on China. That alone is probably one of the biggest tax increases that have occurred in recent history. These tariffs are well above the pre-April 2nd level, and probably they're the highest since the 20th century. The early 1910s and 1920s, and probably Smoot-Hawley in the 1930s. That is significant. All right, and I do believe that we still have to feel the effect of that. That puts tariffs in its own box. Addressing the fiscal side of things, we have the big beautiful bill coming through that puts deficit spending galore, it's tax cuts, all that good stuff. That alone, the fact that we have the prospect of stimulus should be enough to dispel my TLT bullishness. But I think it's a little bit nuanced than that. While it is true that Doge, and I've always spoken about Doge in skeptical terms, it's not done as nearly as enough as people were touting it would have at the beginning of the year. It still has done something. Not much, but something. We've also had hiring freezes at the federal level. And that is one part of the equation. And if you put that together with tariffs, you basically have all of the growth negative things coming first without any of the candy, all right? Without tax cuts, stimulus, or whatever. And the problem with tax cuts is that as opposed to stimmy checks, for example, they don't act immediately. If they were to give, $2,000 to each individual in the US, people will just take that money and spend it immediately. Great. But when do you feel the effect of tax cuts? Well, the year after, when you file taxes for 2025, which is, effectively April and May of 2026. Now, of course, absolutely. The fact that you have the prospect of a tax cut acts as a psychological, boost. Absolutely. And that alone is a form of stimulus. Absolutely. But when do you feel the effects in your pocket? The year after. It's not an immediate fix, if you will. And why is that important? It's important because, if you will, the fact that we've had massive tax increases in the short term in the form of tariffs, and you've had Doge and federal hiring freezes really not add fuel to that, to government payrolls increasing. And again, the reason why that is significant is because there are other people connected to each federal employee, contractors and all that good stuff. So if a federal employee gets sacked, there's speculation that 2 or 3 other contractors in the private sector get affected as well. So I would keep that in mind as well. So you have tariffs and you have some form of fiscal consolidation, and you still don't have any stimulus affecting the economy, which will come in April 2026. That is, if it actually passes through without a hiccup in Congress, which is possible, but it still needs left to be seen. So we're currently living in a world where the Fed isn't helping, and the fiscal side of the equation isn't helping either. It might help down the line, and it definitely will help because, Donald wants his tax cuts, absolutely. But the world we're living in now is a world where the labor market is weaker than probably a lot of people believe. We have the Fed that is waiting, again, it's on its hands. And you have the fiscal side of the equation that has front-loaded all of the bad stuff first and leaving the tax cuts for last. Hopefully that serves as a great, excuse me, kind of, framing of where I'm at with TLT. And this is where I actually start talking about TLT on the chart. The way I'm behaving, where I'm interpreting TLT is as if this parallel channel has been broken. I'm working under the assumption that we will actually retest the 2023 low somewhere, potentially we might bottom between anywhere $80 and $82, $82.50. And again, why is this significant? You guessed it, because this is exactly what we did in 2006, 2008. Again, TLT likes to do a button to put in double bottoms. It either sweeps the previous low or puts in a slightly higher low, like in 2010 and 2011. Okay, and the way you can visualize this and really visualize why I always talk about 2006 and 2008 is actually just looking at the 30-year chart. Starting in 2005, we have a first move up, followed by a move down, followed by a noisy uptrend, sideways chop, first breakout, W formation, sweep of the previous low or high on the yields, and then the downtrend. Fast forward today. Move up, a move down, a noisy move up, followed by sideways chop, breakout, W formation, potentially sweep of the previous high, and then maybe we get, if again this cycle, if again I'm correct and this cycle isn't as unique as we think it is, we will probably get what we saw in to the latter part of 2007. All right, and I think that this is the growing possibility right here, that we actually do get a sweep of the previous high in yields and previous low on TLT. But eventually we leave, as I've been saying, the tariff drama and all the noise behind, and we go back to focusing on the fundamentals of the economy, which as I've been talking about in this video, are probably weaker than people probably think, which in turn will just be a reason for TLT to go high and for the 30-year and for bonds actually to roll over. Now again, this is banking on, of course, the assumption that this cycle isn't different. And while we might have some factors that definitely make it different compared to prior cycles, eventually it'll play out exactly like every other cycle. And this leads me to my final point, which is supply, the supply of bonds. We all know that governments around the world have a problem with excessive spending. And one of the theses, the way people all go about it, is that there's going to be so much bond issuance that it'll crowd out demand, and that will drive yields up. And as far as the long end of the curve is concerned, so 10, 20s, and 30s, I generally disagree with that idea until I'm proven otherwise, really. And the reason for that is because that doesn't really help to explain the 2010s. If indeed yields respond to supply, well, it doesn't really answer the question, why did yields, effectively plummet during the 2010s in the face of increased spending? And you might say, oh, it was the Fed. It was the Fed that, basically outlawed recessions. The Fed stimulated the economy. It was all shenanigans. But to that, I say that, again, the Fed doesn't outlaw anything. The fact that, we had rates lower and lower and lower wasn't as much of a function of the Fed. It was a function of the fact that we had the malaise during the 2010s, right? Low growth and low inflation expectations. That is what I think 10s, 20s, and 30s react to mostly. They react to growth and inflation expectations. If growth and inflation expectations move up, you can expect the long end to move up. And again, 30s are the riskiest part, because again, they ask for extra premium. All right, absolutely. But the way I'm going about it, again, on the inflation side of things, is that I generally take the under. During this time, we saw immense supply come into the market. And even in the face of that, yields continued to go lower. Again, even with some noise, but yields generally went lower. So that is where, I'm basically at. I'll leave it at that. This has already been quite a long video. So in short, does this change anything? For the short term, again, TLT, in my opinion, is poised to sweep the previous low. Again, unless we have, some event that, changes the course of things, I'm expecting this outcome to play out. I'm still giving it the benefit of the doubt. I'm still not canceling this this parallel channel. Still giving it the benefit of the doubt. But overall, the way I'm operating is that I'm assuming that we will have a sweep of the previous low, effectively repeating what we saw in 2008. All right, and eventually that actually will be a buying opportunity in my point, and that is again further reason why it is always important to keep something on the side, because again, if you get an opportunity like that, again, I would generally be in the camp of taking that, because again, of everything that we've spoken about before, the economic backdrop isn't as strong as it was in 2022. It is in fact weaker. It was weakening going into tariffs. Tariffs probably made it worse. And trade deals will, again, probably take, the worst case scenario off the table, but they still haven't come. And even if they do come, they won't stop what is already in motion. To stop that, you would need some immediate fiscal stimulus, which we are unlikely to have, given the fact that, what we're talking about are tax cuts. And you'll probably feel the effect of tax cuts in a year, leaving us in let's call it an air pocket, where you're left with weaker economy, Fed staying put, and having to deal with all the bad stuff first before you get any stimulus and help out the economy. So while there is some short-term pain, as I've been hinting at in my previous videos, eventually I expect this to be a buying opportunity on TLT and bonds in general. All right, I'll leave it at that. Hopefully you enjoyed this video, and I'll see you next time. Bye.